Financial advisors are often a point of first contact for caregivers struggling to manage the financial affairs of a disabled loved one. Disabled in this context means that the patient requires permanent assistance with one or more activities of daily living. Once a level of care reaches beyond what the family can provide, paying for care becomes necessary. It's expensive and will deplete a client's assets quickly. Eventually, the advisor loses the client because there are no more assets to manage. Then long-term care Medicaid becomes the only source of funds to pay for care. This depletion of assets and subsequent loss of clients is avoidable. Most advisors' knowledge of Medicaid is based on the general financial qualification rules, which is understandable, but this has led to faulty assumptions. In this blog series, I will discuss key exceptions to the general rules that advisors need to know concerning the preservation of funds so that clients don't outlive their assets. Common misconceptions and inaccurate information about Medicaid include Medicaid is only for the poor. Excess assets must be spent down to almost nothing to qualify. The time to file for Medicaid is when there are no more assets available to pay for care. The advisor will lose the account if their client goes on Medicaid. Referring a client to an elder law attorney will result in the loss of business. Medicaid will only pay for substandard care in poor quality facilities. Medicaid is going to take the client's house. None of my clients will ever need Medicaid. The 5-year look-back rule is applied to disqualify the applicant. For clients who are uninsured or have less than $1 million, the only choice the advisor has is to help them spend down to zero and then have them file for Medicaid.